I'm Sandy Catrone, and welcome to Mortgage Mastery. Today, we're going to go over 2025 guideline changes. Um, what we always do is pay attention to what's going on for the entire year. We have a lot of things that we're paying attention to, such as the NAR settlement. And we have to be aware that as things change with NAR, things may also change within the mortgage industry to kind of help our realtor partners. So we're going to get started right now with the PowerPoint presentation. So here we go. So what we're going to kind of review today is our conforming and county loan limits, our income limits, the Home Possible, Home Ready programs, minimum credit scores, the debt to income ratios, and any key changes that have occurred from the NAR settlement. Okay. So let's talk about conforming loan limits. So we all know Fannie and Freddie raised their conforming loan limits for single family properties to $806,500. So that's like a 5.2 increase from 2024. Now, a lot of people were upset because they didn't get their FHA changes in early. The reason for that is FHA is actually per county loan limit. So they're not going to offer this ahead of time, like Fannie and Freddie do. So that's really why. And they don't always follow suit. Now, VA, yes, VA follows our conforming loan limits, but generally speaking, as we're going to discuss in a little bit, that only really comes into play for the VA when you're working with second entitlement. So for our single family properties, just to review, 806,500. For 2 units, we're talking 1,032,650. 3 units goes up to 1,248,150, and 4 unit goes up to 1,551,250. Now we also have high cost areas such as Hawaii, Long Island, New York. So these areas are going to be a little bit higher. So for a single family in a high cost area, you're looking at 1,209,750. And over here, the 2 units, 3 units, and 4 units have also increased based on those high cost areas. So keep that in mind. Now, Fannie and Freddie have 2 programs. We have the Fannie Mae Home Ready, and we have the Freddie Mac Home Possible. And they offer these programs to help low to moderate income borrowers achieve homeownership by offering flexible underwriting requirements and lower costs. So if you have borrowers that are on the cusp of qualifying for these programs, you want to take a look, okay? Because you're going to get a better interest rate, and they're a little bit more flexible as far as qualifying income. So let's just take a quick look at what we've got for these features. So income limits are usually up to 80% of the area median income for both, okay? The down payment is as low as 3%, and they do work with down payment assistance programs. Not first-time home buyers are not necessarily required, but they can't own another home. Okay, so this is not for people that want to be real estate investors or want to retain their previous home, but they have loosened the guidelines with regards to first-time home buyers. Okay, and there's going to be some caveats. On the Freddie program, I believe one buyer had to be a first-time home buyer, and it would appear that that has been lifted as of 2025. You have to occupy the property, all right? It's good for 1 to 4 family properties, condos, PUDs, that's a planned unit development. PUDs are generally considered stick-built. They're not generally considered condominiums. There are different areas of the country where PUDs, like here in Colorado, we have lots and lots of PUDs. They are single family stick-built units, generally speaking, but they have HOAs that small HOAs that allow you to have garbage pickup, snow removal. Some have clubhouses, so but they're not treated like condos. So there is a difference, okay? And then you have homeowner education. So with the Home Possible program, that's Freddie Mac, you're required for at least one borrower to take Freddie Mac's Credit Smart program, and that is free. If it's Fannie Mae, then you are required that at least one borrower take their Fannie Mae framework, and that generally is $75. Now, the nice thing about both of these programs, as income from family members who are not on the mortgage application actually can be considered for qualifying purposes. So if you have an adult child or grandparent that is contributing to the household expenses, but is not going to be listed as the borrower, their income can still possibly be used to improve the borrower's debt to income ratio. Now, as we know, on some of our down payment assistance programs, household income has to be counted. All right. This isn't a must. This is if you're having a problem qualifying, and they have, border income coming in, roommates, things like that, family members living there. If you can document that income for a year, there is a good possibility they will allow you to use that income as long as you don't go over the median, the AMI. Okay. So let's take a look at some other loan features on these two programs. Both are 97% loan to value on one unit properties. Okay. The nice thing about mortgage insurance is that it actually can be canceled once the loan to value reaches 78%. Okay. So if you are going for an FHA mortgage, they had changed the guidelines there that if you put 10% down, your MI insurance will automatically drop off after 11 years. Okay, so they have improved. But with Fannie and Freddie, you can actually, after 2 years of making on-time payments, if the borrower believes the value has increased significantly, they can contact their servicer, request to have the mortgage insurance dropped, okay? And the servicer will do a home valuation report. And if that loan to value is actually 78%, then the mortgage insurance can drop. Every mortgage insurance company has their own caveat on this, but generally speaking, one missed mortgage payment in that 2-year period will disqualify them from that. So they really are looking at that mortgage history, and they are going to order a new appraisal. But this is a good option to get mortgage insurance dropped, which can save somebody a couple $100 a month. So it's definitely worth looking into. You have your flexibility in the income sources for both programs. They will allow income from roommates and boarders on one unit properties. Again, I can't specify this enough. This is only on one unit properties. If your borrowers are purchasing a 2, 3, or 4 family property, they are not going to be allowed to use roommate income, boarder income, or family income because they have income that they can use from the other units to offset that mortgage payment. All right. Now, the difference is the homeownership education platform for Freddie Mac is going to be free. And again, for Fannie Mae, there's going to be a small fee involved. There's going to be more flexibility in the Home Possible for allowing those income sources, whereas Fannie's Home Freddie is going to be slightly stricter on that income from non borrowers. Okay, so if you have somebody that has a roommate, and you can document that you've been receiving $400 or $500 every month from them, Freddie Mac Home Possible is probably your better option. Okay, and you have to always remember our lenders have overlays. So just because Fannie and Freddie may say you can do this doesn't necessarily mean that the lender is going to honor that. Guidelines are just that. It's guidance for the lenders. Lenders have the right to add on to those guidelines with what we call overlays. Okay. The Home Possible is going to work well in areas where the AMI is lower, and the Home Ready is geared a little bit more towards areas with higher AMIs. So there is going to be a geographic advantage for both of these programs as well. Okay. Moving on. Let's talk about the FHA. Now, I mentioned earlier that the FHA is never going to come out and say that they have increased their loan limits like Fannie and Freddie do in November. And the reason why is because it is different in every county. So while this is a standard area grid, a 1 unit standard area is around 524. If you live like here in Colorado, you know that if you're doing an FHA loan in Denver versus an FHA loan in Colorado Springs, that the loan limits are different. Okay. So do not offer an FHA loan on a property if you are in a standard area where it's 524, 225. Okay. Always, always, always look for those county loan limits. In the chat button, I have given you several links. Okay. These links are there to check out the AMI. They're also there to check out your property, your county loan limits. I've also included one for the USDA because USDA is a little bit more strict. And Fannie and Freddie have their own AMI. So make sure that you use those links, okay? And then again, FHA goes by those county loan limits. You don't want to be in a situation where you are literally in one county, let's say El Paso County, and then another county, Denver County, and you quote that you can do an FHA loan based on the Denver county loan limits, because you will have big issues with your borrower having to come up with more money. So please, again, I can't stress enough, check your county loan limits. VA loan limits. Okay, there are no loan limits on the VA if you are using their entitlement for the first time. So those of you that don't do a lot of VA loans, we have a very extensive course at Crimet Financial that will review those VA loan limits, okay, and second entitlements is where those will come in. But if you're doing a VA loan and they're buying a property and it's for $1 million, you're not capped at 806. Okay. So you have to collect their certificate of eligibility to see what their COE, what they have in there, and it's worked off of that. Okay. Now I've also given you a link for second entitlement to see what the max would be. Okay. If you click on the second entitlement link, basically what it is you need the certificate of eligibility. So we're going to stop the share for a second, and I'm going to bring up a certificate of eligibility for you to take a look at. Okay. This is your COE. Okay. Here is a loan limit, and here is the entitlement charge. If you take this entitlement charge and you multiply it by 4, there's your loan limit. If you're looking to see how much entitlement they have left, if they're using second entitlement, this is where you would take the single family loan limit of 806,500. You would subtract the 289,12, and what would happen is you would have your maximum entitlement, which would be around 525 and change. Let's see. I don't have that up right now, but there is a calculator in the chat button that you can look at for the loan limits. So let's go back. Let's get out of here and let's go back to our PowerPoint. Here we go. Let's get back in. Okay. So no loan limits, first entitlement. Second entitlement is when the 806,500 comes in. You need the COE to figure out how much they can borrow before they have to put a down payment down. Now, if you want to learn more about VA loans, we have a great VA program and CRIMAT. If that's the only thing you're interested in, I strongly suggest you go in. The course is $49. You get it for 30 days with all the resources. And you get the free mortgage support room as well. And it may be worth it to take that course so you have a better understanding of how the second entitlement works. Again, USDA. Okay, USDA loans are similar to FHA loans, where it's going to align with the baseline conforming loan limit. The actual loan amount, though, is going to depend on the eligibility of the property. The property has to be in an eligible area. If you're doing a home in, let's say, Denver or New York City or Chicago, they are not going to qualify for a USDA loan because it's based on rural areas. Okay. So if you live in an area where you have rural areas, I would strongly encourage you to look into the USDA loans. All right. I personally, where I did the majority of my loan origination was in the Manhattan, Long Island market. So I actually have only done a handful of USDA loans in my career. They are very great loans to use in those rural areas. They can be slightly convoluted. It takes time. If somebody's in a rush, these are not the loans to be using for a rush. These are loans that are 100% financing, and they are based on household income limits as well as area qualification. So again, in chat, I have included the USDA link for you to go in and play around. You can put in a zip code, see if that zip code area qualifies for USDA, and then you can see what the median income looks like. I strongly urge you to go into NAM or some other company and take the certification training for USDA. If you jump into it, there's a lot of caveats that don't make sense. They don't use AUS, they use GUS to see if it qualifies. They have more strict credit qualifications, generally looking for at least a minimum of a 640 FICO score. Okay. Again, household income limits. So if they are living with mom and dad who get Social Security income, they're going to be counting that as the qualifying income to make sure you don't go over those AMI limits. All right. So there are a lot more factors involved. They also have stricter ratios, generally speaking. They have a top ratio, housing ratio of 34, and they have a back end ratio max of 43. Okay. And again, you need a lender that has the GUS. Changes that have come out from the NAR settlement for our conventional mortgages. Generally speaking, sellers are going to have always covered the buyer's real estate agent commission. And in the past, the listing agent, and the buyer's agent negotiated those terms. NAR, as we know, has changed that so that now only the listing agent is charging the seller, and the buyer's agent either would need to be done in a seller credit, or the buyer would have to pay for it out of their pocket. Now, the good news is that they're not considered IPCs, which are interested party contributions. Okay. And depending upon the loan to value, the seller can be capped between 2 and 9%. So currently, right now, there are no changes to Fannie and Freddie selling guide policies, but they are both monitoring this situation. And so we in the mortgage industry need to pay attention to any changes that may come up in the future to help accommodate our realtor partners with the NAR settlement. And that's also going to go the same for FHA mortgages. Okay. And USDA does not consider real estate broker fees to be included in IPCs. So they have released zero information. They have made no formal statements to any changes that they're going to be making to their current policies. Okay. They are monitoring the situation as well. And we need to pay attention. Seller paid commissions. Sellers are allowed to continue to pay buyer side real estate agent commissions without these payments being classified as an IPC. The VA will also allow buyers to pay agent or broker fees. And this charge change is in response to a potential shift. VA has very strict caps on what you can charge. If you go borrower paid on a VA loan, there are a lot of things that could cause problems because you are capped at 1%. Okay. Again, they're not considering these IPCs. And the borrower can request that the seller cover the buyer's agent commission as long as it doesn't go past the 4% cap on seller concessions. Now, VA has they have seller concessions and credits. They're different. So don't think that you're capped at 4% on a VA loan. It's just the verbiage. We have a cheat sheet for our VA, the seller contributions, what is considered the seller concession and what is considered a credit. And so feasibly speaking, we have had sellers that actually have paid debt down for our veterans to qualify under a seller concession, and then they pay for other closing fees on the other side of that under credit. So it's not really capped at 4%. It is and it isn't. And again, we can do a training on that, or you can take the training in the Learning Center that goes through the 4% cap versus seller credit. Okay. So again, with the new guideline, buyers agents can negotiate the scope of services and the corresponding fees. They want this transparency specifically to allow borrowers to select services that fit their needs and budget. So a borrower can negotiate with a buyer's agent on how much they are willing to pay that agent. Okay, so it's not 6%, 3 and 3 anymore. It's really going to be between the buyer and the buyer's agent. So these changes, the VA allows buyers to pay agent and broker fees. They can now negotiate and agree. Seller contributions, borrowers can request that the seller will cover the buyer's agent commission, provided it doesn't exceed 4%. But again, like I said, don't worry about that because there's another side of seller credits on a VA loan that isn't capped. Okay, so with these new guidelines, negotiations can take place. Now, if you want additional trainings, okay, or you want some free resources, you can go here. Let me just make sure you're seeing this. Sorry. Let's just go back. Okay. You can go to CrimeApp Financial Learning Center's website. We have on our website free resources. These free resources, the mortgage calculator, gives you lots of different calculators. If you need an amortization schedule for one of your borrowers, you can do that here. If you need to do a comparison, early payoffs, whether or not it makes sense to refi. We have our traditional rent versus buy calculator, blended rate calculator. This is a very important calculator that we use when people have a first mortgage that's very low on the interest rate, and they need to take equity out of the property and they're thinking of doing a HELOC or a second mortgage. This will give you the opportunity to see whether or not it makes sense to refi or if they should do a HELOC or a refi. So there's these resources right here for you all. You can also download on the site, you can download our free ebook. All right. And if you are only interested in taking individual courses, the membership, it's only $79 a month, but we do allow you to just purchase individual. So if you're just looking to tweak your income calculations, you can do a single course purchase. It's $49. It still gives you the resource center for 30 days, as well as the mortgage support room for 30 days. Whereas the membership is unlimited. You can take all the trainings, $79 a month gets you all of the trainings. So it's up to you what you're looking to do. So if you have any questions, you can reach out to me either through my website, or you can reach out to me through my email, sandy@crimat.com. So thank you for attending. Take care. Bye-bye.